If we went into a global depression tomorrow, do you know how you would protect yourself? What's up, everybody? I am Jaspreet Singh and welcome to the Minority Mindset and welcome back to Make It Happen Monday. Booms and busts are a part of the economy. It's a fact. They happen. There are times when the economy is growing and jobs are growing and people are spending and everything is going up, and there are times when the economy is coming down and people don't have as much money and people aren't spending and jobs are being cut. There are ways to protect your finances and there are ways to make money in every single market and economy, but you need to know how. And today's video was inspired by this question. If we hit a global depression, what happens to rental property value in Canada? Canada, USA, India, it doesn't matter. If we go into a global depression, it doesn't matter where you live, you're going to feel the effect of it in one way or another, and the things that you need to be doing with your money are gonna be the same regardless of where you live. That's why today I'm gonna be answering that question and talking about what would happen if we were to enter a global depression, and talking about different stages or different types of depressions we could see. So make sure you watch this video until the end, but before I get into that, make sure you hit that thumbs up button below and subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week. Let's start by understanding this. Recessions are a part of the economy. They have happened in the past and they will continue to happen. Take a look at some historical ones. So we all remember the Great Depression from history class. That one lasted a duration of 3 years and 7 months. Then we had a recession in 1937, 1945, 1949, 1953, 1958, 1960, 1969, 1973, 1980, 1981, 1990, the early 2000s, and then 2008, that crash that we all remember. Now, not every recession is a major worldwide epidemic and problem. Some recessions are smaller and some are much larger. Like what we saw in 2008 was a major recession. And the difference between a recession and a depression, according to Google, is a recession is a contraction of the business cycle, like we talked about, and a depression is a prolonged period of economic recession. Essentially, a depression is a big recession. When a recession happens, you start to see this downward spiral of the economy, and if you want to stop this from going into a depression, you need to stop this downward spiral as fast as possible. The first thing that happens is consumers have less money, so they have less money to spend. And when people have less money to spend, then businesses make smaller profits. Now, when businesses make smaller profits, that means that they need to cut employees to make up for this loss. Now, when you have employees that lose their jobs, now you have people who have less money to spend. That means you have less people spending money, which means more businesses are gonna need to fire people and more businesses are gonna need to let people go. And now you have more and more people who don't have money. Now, when people don't have money to pay their bills and pay their loans, now, people don't have money to pay their mortgages, they don't have money to pay their car payments, they don't have money to pay their credit card payments. And now you see banks start to get affected because now people are not spending money in businesses, so businesses are letting people go. And now people don't have money to pay their bank back. And now banks start to struggle, and so banks have to first lay off employees because they had the same issue as everyone else. They don't have enough money to survive, so now they start firing people. And now, because of the state of the economy, if this keeps going down, banks need to start creating tighter regulations. So now they make it harder to get a loan for businesses, they make it harder to get a mortgage for people, and this makes it even harder for people to spend money. And so it keeps creating this downward spiral where it's people who don't have jobs, people who don't have money to spend, people can't spend, so businesses can't make money, businesses can't make money, so they can't hire employees, businesses can't hire employees, so people can't borrow money, and this keeps going on and on and on. During this stage of a recession or a depression, this is the perfect time to be an investor who has cash, because right now there's no confidence in the economy, and so the stock market is tanking and people don't have money to make their mortgage payments, and so foreclosures are up, and so home values and real estate values are low. So if you're an investor with cash during this stage, you can come in and you can start buying investments in the stock market and the real estate for dirt cheap, for pennies on the dollar. I got into real estate after the 2008 crash, and you could buy real estate for pennies on the dollar until 2013, 2014. So I was squeezing every single cent that I could out of my finances. This way I could buy as much real estate as possible because it was so cheap. On the flip side, when you see a recession in this stage, this is when you see commodities like gold shoot up in value, because when investors see blood on Wall Street, they turn their money to save commodities like gold because gold tends to be a safe haven for the next stage, which I'm going to talk about right now. The second layer of worry and complexity happens if this downward spiral can't be stopped, and so now the government keeps printing money trying to fix this problem, and you end up in a state of hyperinflation. Our dollars, our paper money is currency. And this currency, this paper money that we have, is not backed by a physical asset or tangible asset like gold. It's backed by a promise of the United States government. And if the government were to print too much money, like if they were trying to make up for a recession by printing money to stimulate the economy and they ended up printing too much money, you could end up in a state of hyperinflation. We've seen it happen in the past. During World War I, modern day Germany was running out of money. So the government came in and they decided to take their money off of the gold standard, and then they started printing all this money, all this paper money to finance the war because they thought they were going to win. And then they didn't win the war. And then Germany ended the war with all this debt, and they had printed all this money that they entered a stage of hyperinflation. You might remember seeing pictures like this in your history book where people are literally just playing with cash and walking around with wheelbarrows of cash because money was worthless. Their paper cash was worthless. I want you to read this right here. In 1914, the exchange rate of the German mark, which was their currency, to the American dollar was 4.2 to 1. 9 years later, it was 4.2 trillion to 1. Their paper currency became worthless. And this is a really interesting chart where it shows in 1919, it costed 117 German marks to buy 1 ounce of gold. Well, just a few years later, it cost, what is this, $87 trillion. 87 trillion paper marks to buy 1 ounce of gold because of this hyperinflation. That's why when I told you about that wheelbarrow full of cash, people would go shopping with wheelbarrows full of cash because their paper money became worthless. Now, I know World War I was a long time ago and it seems like that could never happen again, but we saw something really similar happen in 2018 in Venezuela. In Venezuela in 2018, they were having a ton of issues and they were printing a lot of money and they entered into a state of hyperinflation as well. And so the government had to literally change their currency overnight to try to nip this problem, and so people's cash became worthless. Now remember, this happened in 2018, so this isn't like ancient history, but they saw right here that inflation could hit 1,000,000% in 2018. That was their concern, that they could see 1,000,000% inflation, and this new currency, this $1 of the new currency was worth $100,000 of their old currency. If you were to enter this sort of hyperinflation where you're seeing close to 1,000,000% inflation a year, I'm sorry to say it, but if you had a very, very big bank account, it becomes worthless. It doesn't matter how much cash you have at that point. At that point, the only thing that matters is how much tangible assets you own. That would be things like real estate, oil, gold, water, things that have real value. This is another reason why real estate investing is so powerful, because you own a tangible asset and you own something that is valuable. And if the government were to change the currency to chickens, you still have an income source because now you can charge your tenants in chickens instead of dollars or whatever the currency is. Now, obviously, we can all hope and pray that this sort of hyperinflation never happens, but it's kind of out of our control. So a smart financial planner would always plan for the worst. So what does this mean for you right now? Well, look, nobody can predict when a recession will happen, how big it will be, what's going to cause it, and what's going to be the extent of it. That's impossible. What you want to do is you want to be financially smart. That means stop financing your clothes. Put some money of your paycheck every single month towards your investments. Buy some tangible investments like real estate, maybe gold. Buy some. It doesn't have to be 100% of your portfolio, but you should have a little bit of these tangible investments. This way you have something to fall back in a worst case type of scenario. Pay off your consumer debt and work to create more income. This way you have more money to invest in things that will pay you for owning them. This is what financial education is all about. This way you can be prepared and you can protect your family no matter what the situation is. When the economy is good, you're going to see your investments rise and you're going to see more money coming in. When the investment market comes down, that's when you can come in and buy. And if you see the worst case scenario happen, you have tangible assets to fall back on. And if you want to learn more about money management, investing, and financial education, we have a free ebook on money management and investing, and you can read it for free when you sign up for our financial education emails, which are also free. And you can do that by clicking the link up here or by clicking the link in the description below. Look, I know this was a scary video and it sounds like an apocalyptic type thing, but you're a lot smarter now that you know this. And if you want to learn more about investing in real estate and how you can do that, I already made a video and you can watch it on YouTube by clicking this button right over here. Thank you for watching. I'll see you next time, and as always, keep hustling.